Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 12th of December 2021. So I've got two titles for this video. Gold for me, not for thee. And when I say me, I don't mean me. No, by me I mean I'm talking about those in power. What I'm wondering here is whether it's possible for middle class gold owners to not benefit from a substantial rise in the gold price, while those in power do. You might say, well, what's this got to do with you and your gold being on a list? Well, I'll explain. A lot of gold owners are hanging on to the possibility of $10,000 per ounce gold, leading to riches and gains in purchasing power. But just how realistic is this outcome? I've already spoken a bit about this in my video, how gold owners could get shafted. So if you haven't seen that, go back and have a listen to that. But let's look at it from another angle. One way that a five-figure gold price could be achieved would be through the adoption of a gold-backed currency. And it's something that a lot of people are assuming will happen. Now, currently, such a thing does not exist anywhere in the world. The last gold-backed currency was in Switzerland, and they ditched that back in the year 2000. The advantage, of course, of having a gold-backed currency is that it does protect against hyperinflation. This is because it limits the ability for those in charge to print excessive amounts of currency. As a result, it also limits government control. How likely is it that any country would willingly return to a gold standard? Nope, it ain't going to happen. And I actually believe that it's not going to happen. Why do I think that? Well, it's because there are other options available. The number one candidate is the introduction of central bank digital currencies. This is a digital form of fiat that would be issued by the state and would be considered as legal tender. Now you might say, well, don't we already have that, the digits in our bank accounts? No. The difference is that there's no physical version for these CBDCs. So notes and coins for that type of currency would not be available at all. Another huge difference is that unlike the currencies that are in use at the moment, a CBDC would not be debt-based. And this is a big deal because it facilitates the merging of fiscal and monetary policy. And so implementing things like modern monetary theory, or MMT for short, would be really easy. Control of the wallets would be completely centralised. That means that the currency can be deposited or withdrawn at will centrally without your consent, and all transactions can easily be monitored. Now, if you think about that and the implications, you'll see how easy it would be for you to be put on a list. This map shows the countries that are looking at CBDCs, and as you can see, a big chunk of the planet is interested. According to this, they're at different stages of development. So let's look at the couple of countries where the development is most advanced. So we'll look at a couple of examples here. In 2014, Ecuador introduced the Dinero Electrónico. However, that was abolished 3 years later due to a low adoption rate. This was because most of the population actually distrusted it, and so it only accounted for 0.003% of currency in circulation. In October 2020, the Bahamas central bank digital currency went live. This was called the sand dollar, and it's pegged to the Bahamian dollar, which is itself pegged to the US dollar. Now, apparently it's been branded a great success, but one thing I haven't been able to find out is what the transaction volumes of this currency have been since it went live. If anyone knows that would be interesting to know. So, of course, acceptance is a potential hurdle for CBDCs, especially in countries where trust in institutions is low. However, I think there are plenty of countries where the population will voluntarily embrace it. Judging what I've seen down under over here, they would absolutely lap it up here. So just a basic, all it would take is a bunch of ads saying how cool and convenient it is, and especially if they put a $10 sweetener in the wallet, loads of people would just dive in there. Welfare states could easily attract punters by stipulating that benefits will only be paid into CBDC wallets. Businesses could get roped in too by basically diverting business support payments to wallets every time the economies get kneecapped. Also, the introduction of universal basic income payments would attract wallet acceptance. The other thing is bank bail-ins. That would be a great opportunity to introduce CBDCs. So once it's been decided how much of your bank deposits you're allowed to keep, then that balance could automatically be transferred to the central wallet, whether you like it or not. So all in all, I reckon the majority of the population in many, many countries could be lured into acceptance. So overall, I think the introduction of CBDCs is very, very highly likely in numerous countries. The next question is, does a CBDC have to be gold-backed? Now, from this point, I'm actually pretty unclear. And so I'm just throwing out some ideas here. I think that if it is just used for domestic transactions, then they'd likely get away with it not being gold-backed. I mean, most people are pretty clueless about the monetary system, and I don't think it'll be much of an issue. But I think if it was used internationally for international transactions of commodities and so on, I think that would be a very different matter. And so gold backing would enhance acceptance between countries. But yeah, what do you think about that? As we know, gold is classified as a Tier 1 reserve asset, and there are central banks that are accumulating it. Interestingly, I heard that Ireland recently increased their holdings, which seems like quite a departure from all the other EU countries that use the euro. Anyway, yeah, I thought that was quite interesting. Now, here it's important to make a distinction between gold-backed currency and a gold convertible currency. Going back to what I said earlier on, it is gold convertibility that I don't think is going to happen. Certainly not voluntarily. However, gold backing is a different kettle of fish, as it still represents a fractional reserve system effectively. And so this is, I think, the more likely option because it prevents gold reserves from being drained away, and the percentage of backing can be varied, and that will provide governments with flexibility in terms of their money supply. Gold backing would, of course, require a revaluation of the gold price. Now, how would that revaluation occur? Well, if you read Jim Rickard's book, he goes through how this can be calculated. But basically, the price would be based on a combination of the money supply of the major economies and the selected percentage backing. So if you had the currency 20% backed by the based on the M1 money supply, then you're looking at $50,000 an ounce gold. at 40% of M1, you'd be at $10,000 gold. If you used M2, then it would be 20% backing would give you $10,000 an ounce as well. But the problem with doing this is that it would cause instant inflation, and that wouldn't be so much of a problem for those with substantial gold holdings, but it would be really, really bad for those who hold fiat. Do you think this is something that's likely to occur? I'm not so sure. If it did, it would probably occur at the kind of central level through the IMF, really. I don't think you'd get one country alone doing this. I'm getting the feeling that there's a lot of global synchronization going on, and most countries seem to be under the thumb of some three-letter organisation or other. Now, just to be clear, I'm not talking about KFC, but the result of this is that I'm just getting the feeling that countries aren't acting as individual sovereign countries anymore. And so that's why I think a lot of this is going to be centrally driven. Let's say that such a revaluation does occur. Now, that doesn't necessarily mean that retail gold holders would necessarily benefit. And I say that because crushing the middle class seems to be a sport lately. It is CBDCs that would enable control of the retail gold market. So, for example, restrictions could be placed on how much gold can be purchased, or such purchases could completely even be blocked. Gold sales could be taxed directly from the wallet, and the taxes could be prohibitively high. I mean, what's to stop them from introducing a 90% tax on it, on any gains that you had? Removing the legal tender status for individuals while maintaining Tier 1 status for central banks would be an example of gold for me and not for thee. The wallets could make it very difficult for people to own and store gold offshore as well. Now, common protests that I get when I discuss this kind of thing include secrecy, not selling, or talk of black markets. Now, for those who have no intention of selling, well, that basically means that that allocation should be considered as wealth that you're going to be passing on to future generations. Of course, black markets have their limitations and challenges, and so what I would say there is that it doesn't exactly fit with the fairy tale vision that I spoke of earlier. So it's not going to be ideal. In conclusion, we know that central bank purchases of gold are on the rise, and of course they'd only do this if they expect to benefit from owning this. But does that guarantee that we would benefit too? How much of a role will gold play in CBDCs, and what are the details of that role? Now, that's something I'm not really very clear about. Could CBDCs facilitate the transfer of gold from the population to central banks? Look, I'm not saying that you shouldn't own gold. What I'm saying is don't be too starry-eyed about the outcome. Understanding the potential pitfalls can help you to allocate appropriately for your individual circumstances. Next up, the market update. Well, the gold price hasn't really done a lot since I spoke to you last week, and I don't want this to be like Groundhog Day, saying the same stuff week after week. So if you didn't see last week's video, that's the same opinion that I've got right now, and nothing's changed. So today I'm not going to go through the same old rigmarole. I thought, look, let's do something a little bit different here. So here we go. This is a chart showing the 1 year performance for various various things here. And so this is from futures performance here. And look, CPI 6.8%. Yeah, right. I mean, look at this chart here. Now, I think, granted, a lot of this stuff hasn't actually filtered through to the consumer yet. So this is almost telling you what's potentially coming. Okay. I mean, look at oats here. Oats did really well, around 115% over the past year. Coffee, and yeah, look, all of this stuff are things that all of us use over here. And so this is a really important chart. It's interesting to look down here, of course, and all of the precious metals are down here. All of them. Actually, palladium was the worst out of all, you know. If silver bothers you, well, palladium did the worst out of all of the precious metals there. Gold's here, down about 3% here. And other than that, though, I think the only commodities here are soybean meal and cocoa. So if you're a chocolate lover, you're probably potentially going to be okay, although you will need some sugar, which will be up in this area here. Okay, total assets in the Federal Reserve balance sheet. What taper? Look at this. This has just kept going up and up and up and up. So if you look here, and this doesn't even look particularly normal here, does it? It's just zigzagging upwards here, and we're $8.6 trillion. They mentioned that they were going to reduce their asset purchases. Tiny little blip there. Yeah. Okay, now this is the VIX, and what I've done here, I thought that after this spike in the VIX that occurred last year, notice that we've got a gap over here, and that actually took over a year to fill. It didn't fill till into April, May time of this year. So that was a big gap though, and so I did think that that was likely to get filled. And basically, since this spike, the price has been going down in this channel here. So the way I drew that was that I joined these lows here and then moved the line up to join this high here, and the most recent spike came pretty close to that before turning around. And you can see that we've got a gap above over here. So just remember, at some point that gap will fill. How soon it will fill, I don't know. But that is there. This one's the commodities index. And I've drawn this on the log scale going back into the 90s here. And what I've done here was join these two lows here and then move the line up to join this high here, and it looks like that touched the line and turned around at that point. So I think if you're looking for a big upwards move in commodities, we need to see a break above this line over here. So that's going to be an important point. Now, I mean, one possibility is that, I mean, yeah, okay, I mean, you could get some consolidation over here before going up. We've got support down below over here, so it's not a perfect line there, but yeah, I mean, potentially you could get a little bit more downside before moving upwards. That's like a little partial decline there, so that's a potential. Could it come all the way back down here? Look, yeah, it is a possibility, but you know, you've had two touches of the bottom trend line and two of the top at the moment. So look, I mean, if you look at that earlier chart that I showed you, commodities have risen a huge amount already. Will it continue? Let's see. But yeah, I'm thinking a breakout to the upside for this stuff here. And let's look at this chart. So this looks at the gold miners, and this is the percentage of gold mining stocks that are in the GDX that are above their 200-day exponential moving average here. And so what we've got here, I've shown this chart before, and back in September, this hit 0. So basically all of the GDX stocks were below their moving average here. But they all moved up, more and more of them moved up to at or above the moving average. And then, of course, they sunk down again. And so we're at this level here. And so we're not too far off that bottom again here, are we? So also, if you look at all the previous times at roughly this level here, price did kind of bounce off of there. So does that mean it's going to move up? Who knows? But it could dip down again before turning around. But it's not something that's happened before. If it's going to come down again, it usually kind of does it very quickly, and it doesn't bounce up quite as high as this here. So anyway, that could be a potential indicator, but let's see what happens. The main thing here is that there is a lot of asymmetry here, so there is more room for more stocks to kind of move upwards. And so only looking at my individual stocks, not stocks that are in the GDX, but individual stocks aren't doing too badly still. So yeah, I'm not overly worried still. I know there's a lot of bearish sentiment out there. This one I thought was interesting. So this is the so what I've done here, I've made a ratio. So this is the Gold Explorers Index, and I've divided it by the GDX. So effectively, this is like the ratio of explorers to the miners. And we know that usually the explorers do better than the miners in a bull market, and they do worse than the miners in a bear market. Yeah. I've also included the gold price, so that's the line in orange here. So when we get downwards move in this ratio, what it means is that the explorers are underperforming the majors. So for instance, say all the miners were dropping, this means that the explorers dropped a lot more than the majors. Okay. Now the interesting thing here is that this ratio peaked over here, whereas the gold price peaked over here. And you can see that coinciding with this peak, so you already started to get a drop, and then it dropped dramatically from that point onwards. And even though price recovered here, it didn't recover here and just kept falling. So the ratio kind of bottomed out over here, but of course the gold price bottomed out over here. So this bottomed out earlier than the actual gold price, which is interesting. Now, of course, it kind of moved sideways over here, and it's really in 2015 that the explorers were outperforming the majors over here. And so again, that occurred before the gold price bottomed at this point here. So from this point upwards, the gold price has been moving up over here. So here, let's say it's a bit of sideways movement, but this ratio just dropped, and it only actually bottomed over here. So it actually bottomed after this low over here. Now what we're seeing here is a huge kind of divergence in the way that this ratio has been moving here. And actually the explorers, basically what it means here is that the explorers haven't been pummeled as much over this time. Over this, basically here was where the correction started in the gold price, but this ratio has kind of moved sideways, so the explorers haven't been punished very much here. The other interesting thing is that I joined this this high here to this high here, and that led to predicting this bounce over here. And interestingly, just at this point here, we got a breakout above that line, which kind of coincides with this line here in the gold price. Now you'll remember that was actually one of those wick bottoms where, I think it was back in August, where you got that wick down and then a wick up, and so it's not shown on here. This is just a closing price line here. And since that point, this is broken out above, and it looks like it's come back to retest and then moved upwards. And this chart is on the weekly scale. You can see that the ratio started to move upwards over here. Is that a sign of something? Who knows? Who knows? But one of the things I like about this chart is, okay, look, yeah, you could be very bearish and say, yeah, there's a whole ton of downside here. But look, I mean, how much lower can this ratio go? You know, I mean, we're not far. The lowest here was about 0.75 here. And that's kind of as far back as this chart goes. That's the record low. And so, okay, say we were to go back down there and make a double bottom before moving up, which I don't actually think is going to happen. But look at the upside, you know, and it's that asymmetry that I look for rather than, you know, small moves here and there going up and down. So it's the asymmetry that's important here. So what that means is that there's a huge amount of asymmetry to the upside for the gold explorers. Right. So yeah, I thought I'd do something different. I hope you don't mind. If you missed last week's show, that's basically my opinion for this week as well. It's not really changed. And basically, we're not going to know until we break out of that sideways movement. So let's see. Let's allow it to pick a direction. So yeah, that's it for me this week. I was thinking the other day, I'm actually in the last generation, or well, I should say the youngest generation, to know what it's like to live without a significant amount of technology. You know, basically I grew up when there were no mobile phones, no laptops, and yeah, it wasn't like being in a cave or anything. You know, it was quite a nice life. I quite enjoyed it, you know. And so yeah, kids these days, they don't actually know a world without technology. So I thought that was interesting, because actually I think things were better back then in many ways, because people actually used to talk to each other. I think nowadays people are either, you know, zombified by their phones, got headphones on, or they talk at each other. So yeah, it's a bit sad. But look, I'm not going to complain too much about technology, because there are big pluses as well. Although I think my gripe is that people don't use it necessarily to their advantage. They use it to their detriment. But yeah, I think the good things about things like YouTube and other technologies is that it can be hugely educational, and you can connect with people that aren't necessarily around you in real life. And look, I get to connect with you guys. So thanks to all of those who commented last week. It felt like a nice big virtual hug there. Thank you. Right, that's it from me. See you next week. Bye.